Welcome again. It's Natasha Watkins, your favorite realtor, and I'm here with Peter Karlin. What's going on, my friend?
Good to see you.
Look, we got to come up with a nickname for you. I can't be your favorite realtor and not have something to introduce you.
Well, I told you, somebody just came up the other day with, they told me that their nickname for me is the surgeon. Surgeon.
Nice.
So
nice,
I was
nice.
like, okay, I'll take it. I guess that, a good surgeon, a proficient surgeon.
I love it. I love it. I love it. I love it. I think that fits you, man. Like the way that you dissect each and every loan. And one of the reasons why I work with you so much is that I know that anyone that I take to you, even if there's no way for it to happen, that you'll try to figure out the best way. There's so many people that I bought, and we know that the loan isn't going to work, but we'll spend 30, 40 minutes trying to figure out the best way to make that happen.
Thank you.
That's why you're one of my
Thank
favorite
you so
guys,
much.
man.
I just spoke with my team the other day, and I reiterated, because that's my ideology, by the way. And thank you so much, because my belief is you've got to keep people, you've got to give them hope. You've got to give them the way to get the home, right? How to make it work. If it's not today, and it's not next week, and it's not next month, maybe it's next year. Maybe it's a credit fix, or maybe you don't have the assets, or whatever it is. You haven't been in your job long enough. But one of the things I say is, let's give somebody a way. Let's give them a path to how to make it work in the future.
100%, 100%. Yeah. I think like the thing is with your team is that you guys offer so many scenarios in order for everything to come to fruition or to actually get the loan down. And I think today we have one of the biggest things that we could offer. You guys are doing a 0% down payment. Can you tell us a little about that?
Tashwa, it is truly awesome. I mean, I give so much credit. Matt Ishbia and United Wholesale Mortgage, UWM, they came out with 0% down on a purchase. And it's not just for first-time home buyers. It's truly an amazing program. They will give it's not free money. It's not free money. However, it is a 0% interest loan on a second lien to the first lien of the house. And when I say lien, I mean loan. It's synonymous, right? So how it works is the following. And it's 3% up to and including maxing out at $15,000. And does not have to be, did I say this? I forget, a first-time home buyer.
No worries.
Does not have to be a first-time home buyer. So here's how it works. So let's say somebody buys a house for $500,000.
Yeah.
$500,000, and their first lien is $485,000. They're putting down 3%. 3%. 3% is $15,000, right? So $15,000 is the down payment, and that would be the second lien, right? That would be the zero interest loan, and then the first lien is $485,000, right? So that second lien is not due, 0% interest, not due until the first lien is done.
Okay.
Which means you either refinance out of it, or you've paid it off over time, or you sold the property, right? That's when the second lien is due.
Yeah.
But who's doing that? Nobody. Nobody's doing that. So it's a truly incredible program.
Yeah, that's amazing. And I think one thing that I picked up that you said, I'm going to iterate, is not just for the first-time home buyer.
Yes.
Definitely.
Now it does have to be a primary purchase. It has to be a primary home.
Okay.
And it cannot be a multifamily. Okay. So other than investments, right? So no investments, no multifamilies, and you would qualify. And as little as a 620 credit score could get you into this program. Yeah, which is pretty amazing. Conventional loan.
And there's no restrictions on where you can move to or anything like that, right?
No, there's no restrictions. Yes, sir.
Yeah, I think where we can go with this as well, like for instance, a lot of people, they're worried about moving into a new place and maybe even want to keep their old place. They can move out of that original place, maybe even sublet it or rent it out.
That's correct.
And then if they need more space or anything like that, now do a new loan. So now we have our original home as an investment property.
That's correct.
And now switched up and move into something bigger because our family's growing.
That's
definitely.
correct, 100%. Yep.
No worries.
Really cool.
And then I think you guys had a different program as well too, right? Where we have up to $5,500 down.
Correct. Right on. That's another awesome program I've been offering and give every time a client comes to me, actually, who's doing a conventional loan, and always offer them this. It's called the Home Ready Fannie Mae Home Ready SPCP program. SPCP. And what that is and this is super cool. It's two stipulations. That one of the buyers is a first-time home buyer and living in has to live in the property, okay, as a primary property. And the second stipulation is that they live in a metropolitan statistical area, an MSA.
Okay.
Right? And what is that? It's an area that the government deems, they want to give
Build
money.
up.
They want to, and it's where you live. It's not where you're moving to. Right?
Okay, that's very important.
Very important. It's where you live, and how do we determine that? And we basically type your address into a database, and we just check to see if your address is in that MSA, in that metropolitan statistical area, and you're a first-time home buyer, and we'll give you 5,000. Now this is really cool because it's not like the 0% interest loan.
We have to pay it
This
back.
is free money. This is down payment assistance. We call down payment assistance or DPA.
Okay.
So it's $5,000 DPA plus a $500 appraisal credit. So $500 towards your appraisal and $500 towards the home warranty. If it's a new home, if it's a new construction home and you have like a warranty, then you get $500 off of that as well.
That's crazy. That's crazy. So the original one, I think you were saying that at the end of it, they will still have to pay back the 15,000.
Not the second lien. They would have to pay back.
But is that over time? Are they paying that over the time of the loan as well, or does that extend on that?
No. You're paying that when the loan is. When that first lien is out, when the first lien is over. Yeah.
So when that second lien comes in, are they going to get a new payment for that? How can they pay that off over time, or they have to pay the full 15?
It's a 0% interest loan, so I don't think you'd want to
pay it over term. You want to pay it off all at once,
it's
right?
0% interest. So, but I guess I would gather if somebody wanted to pay off that second lien, they could, but
pay it over time.
But I don't imagine anybody would want to do that.
Yeah. So it's just something, and again, it's like 30 years that you have to pay this off. Or even if you're thinking of move, you will factor that into the new loan that you're going to do if you was going to move as well. And on average, I think they said that most people, I think it's gone up since the pandemic, but on average, they think most people stay in their home for about 7 years or so.
That's what I've heard. So I've heard. I don't know about staying in the home, but staying in the loan for 7 years.
Got it. Before they
refinance, sell. Yeah,
definitely.
Yeah.
And when even if, and we know that the rates are going to come back down a little bit, so they may even opt to refinance out early and still factor in this $15,000 into that new loan to bring down the interest rates as well, right?
Correct.
Definitely.
Correct.
No worries. And going from that, I think one of the things that we really wanted to talk about as well as we know that everybody's been talking about what's going on with NAR and what's going on with the lawsuits and everything like that. I really wanted to touch base and see how that's going to affect you guys on the mortgage end. I know how it's affect us as a real estate agent, but how does that translate to you guys?
Well, it could, a couple of things. I think that it will be more challenging for buyer's agents, right? I think it'll be more challenging and those of us who are mortgage loan officers who work with realtors or specifically buyer's agents, and there's a lot of us, right? It could be more challenging for the mortgage loan officer as well as the buyer's agent. However, you and I have discussed this as well. There are, and I know you've been, your team has been very trained on this. I know.
We've been working on this for a while.
I know you guys have been gearing up for this, but what'll happen? We spoke about the seller's concession before, right? And the seller's concession is a huge hit. I mean, it's a huge hit, period. But it's going to could be even more so now, where you're going to build in the credit for the buyer's agent through the seller's concession. Right? So let me just do a quick explanation.
Sure.
So
Seller's
concession. Seller's concession is when the seller concedes something, right? A concession to give up, to give up. And what are they conceding? They're basically giving a credit to the buyer to offset the buyer's closing costs. Right? It's an offset of the buyer's closing costs. I have a lot of buyers who come to me and they say, hey, I want to roll the closing costs into the loan. Well, you can't do that. You can do that on a refinance. You can't do that on a purchase. But you can with a seller's concession. That's with the concept of the seller's concession, you can do that. So here's how it works. The seller gives a credit to offset the closing costs. let's take a $500,000 purchase. The seller and the buyer agree on $500,000 is the sale price, right?
Yeah.
But now the buyer's agent and the buyer say, hey, Mr. Seller, Mrs. Seller, can you give us a $30,000 seller's concession to help us offset the closing costs? And part of that closing cost might be the buyer's agent's commission.
Yeah.
Right? So, okay, you give me $30,000. So the seller says, I'll tell you what, I'll give you your $30,000 concession, but I still want my $500. I want my $500. So now the purchase price will be $500 plus 30 is $530,000.
Okay.
So the purchase price is now $530. Right? $530. $500 to the seller, $30 to the concession, built in, financed over the life of the loan. Right now it becomes part of the loan, and now the buyer doesn't have to come out of pocket with $30,000.
Yeah.
Right. The only downside, you've heard me say this before. The only downside to the seller is that two things why a seller wouldn't do this. Number one, because the seller has so many offers.
Yeah.
And those offers that they're getting don't require, they're not asking for a concession, right? That's one reason. And then the second reason a seller might have some trepidation or nervousness about doing it is because they may feel that the house might not appraise for the 530. It's got to appraise for the 530 rather than the 500, right? But as you know, we have a brilliant real estate attorney that we work with. I'm sure other attorneys do it as well. I'm guessing. I don't even know, but our man Usman Malik of AM Law Group. Usman, we love you. He builds into the contract a clause to make the seller feel comfortable that if the house doesn't appraise for that over the 500, right? Then the commission, the concession will decrease down to the 500. Where the buyer will have to come up with their closing
with the balance.
With the balance. So, for instance, if the house appraises for 510 and the seller, wants his 500, then there's 10,000 between the 5 and the 510. The $10,000 becomes the new concession to the buyer, and now he's got to come up with the remainder of the money.
Yeah, and I think that's good for a lot of buyers who want to keep a little bit of that cash still in their pockets.
100%.
For example, like when we move into a new house, there's things that maybe we want to furnish the house and everything like that.
Furnishing.
Yeah, definitely. So they do have that money in reserve just in case that it doesn't go through or it doesn't appraise for that full 530.
Yeah.
But if it does appraise for that 530, now they have a little bit of reserves in their pockets, whether or not And you always want to have a little bit of reserve whenever you're purchasing a house anyway, just for the fact it's a house. They've been here for, depending on if it's not new construction, you never know what can happen a couple years down the line, and you
100%.
never know what can happen to you in the economy if you lose your job or something like that. At least you have a little bit of those reserves to fall back on. Definitely. And I think we did. In terms of the concession, we did some of that stuff with the 3-2-1 buy downs, right? Where we were
exactly
have the concession.
Exactly.
Definitely.
And what Atash was speaking about is the 3-2-1 buy down, or the 2-1 buy down, or the 1-1 buy down, or the 1-0 buy down. So those numbers represent, like 3-2-1, represent the number of points, percentage, minus the current interest rate. Well, it's kind of so
it's a tricky.
It's a little tricky. So I'll give you a quick example, right? So on a 2-1 buy down, let's for instance say that the interest rate, the current interest rate today is 7% on this particular loan, 7%, and someone wants to buy into the 2-1 buy down. So the first year would be 7 minus 2 is 5%. So the interest rate for the first year would be 5%. And then 7 minus 1, 2-1, right? 7 minus 1 would be 6 for the second year.
Yeah.
So 5% interest rate for the first year, 6%, right, it steps. 6% interest rate for the second year, and then it goes to the 7% in the subsequent years, 3, 4, 3 and out. Right?
Yeah.
The idea of the buy down concept, the 3-2-1, the 2-1, the 1-1, is that you're gonna get out of this loan, right? The whole thought is, right, because many of us in the mortgage and real estate business and the economic world, we believe inflation's coming down, right? And when inflation comes down, mortgage interest rates are coming down, right? And when interest rates come down, there's going to be a refinance boom, right? There's going to be a refinance boom. There's also hopefully going to be a buying boom. I
Yeah.
think there's going to be a buying boom because a lot of the sellers, and we discussed this as well, a lot of the sellers that are waiting because they're afraid, they don't know where to go, the higher interest rates, if they get out of their home right now, they're sort of waiting. So the inventory is lower. Right?
Yes,
than
100%.
we typically see. So when that happens, that's when you refinance out of this. And I apologize. Natasha,
No.
tangent, but I wanted to explain what the buy down.
No, that's 100% good.
Thank you.
That's all good.
He's gracious man. So you're taking the credit from the concession to put. Yes, you can use that towards the buy down.
Yeah, 100%. No, this is all really, really good stuff because, like, people got to understand. We know that the interest rates are a little bit higher, and I think we spoke about this. When I speak to people out there that's in that buying process, all of those buys, they still think that we're in the high sevens. You'd be surprised.
I just gave someone this week. I'm happy to tell you here a 5.74% interest rate, FHA loan, 609 credit score,
Nice.
609, right? Now they paid about 60.6 points, about 0.6 points to get that rate, something like that. But a 5.74, forget it. I mean, conventional rates, I'm giving around the low sixes.
Okay.
The low sixes. So no, we're not in the sevens, although the average, and rates did come down this week, by the way, because there was a great indication by the consumer price index that we're heading towards a downturn of inflation's coming down.
Yeah.
So,
Didn't the employment report came out a couple weeks ago as well,
Yes,
right? And it was
yes.
a really, really strong.
that was strong. That went against us.
Oh,
That actually
okay.
went against us. So
I thought that would go.
No,
to us.
employment was strong. So we want to see.
Oh.
Yeah.
See, I just learned something new today.
So it's really interesting because when things here, think about this. When COVID hit, that's not good for the world, right? Everybody freaked out, right? We don't know. It's uncertainty. That's a good word, uncertainty.
Yeah,
right?
yeah.
When uncertainty exists in the marketplace, typically rates come down.
True.
And why? What's the logic? Well, in fact, I mean, this is sort of the government wants to keep people spending.
Yeah.
Right. Government doesn't want people freaking out. So how do you keep people spending? Lower the interest rates. Right.
Got it. Yeah,
but
yeah,
when
yeah.
inflation is good and unemployment is low, and and prices are high, well, then rates are high. Right.
Yeah.
You want to push people back. You want to sort of slow things down.
Yeah.
Right. So when the employment numbers came out, they were actually really good. Like it's what we want to see we want to see
bad employment.
I mean, it's unfortunate. It's hard.
Yeah, it's just the way
hard
that
to
the
say.
system
We don't
works.
wanna say, we want to see bad happen. We don't want to see bad happen, but we want to see a slowing, right? We want to see a slowing.
Yeah.
Yeah.
So it's good for your pockets, but just bad for your interest rates, pretty much.
Yeah.
Let's just leave it at that. Let's
Yeah.
just leave it at that. And there was something else that I kind of really wanted to touch on that kind of slipped my mind in terms of that as well. So we're in a good position in terms of whatchamacallit, which brings. But you said that the interest rate still came down, though. Why is that?
Well, this past week, the biggest thing that happened was that it's all about expectations, right?
Yeah.
So the economists, the market watchers, the people on Wall Street, they all have expectations of what's going to happen, right? Where the unemployment's going to be, where the employment's going to be, where the consumer price index is going to be, all these different factors in the economy, right?
Yeah.
And if we fall under, well, it depends on the economic factor, but like if this consumer price index, we were under where we thought we would be.
Yeah.
It came in lower, which when it comes in lower than expectations, sort of like unemployment. If unemployment versus employment, right? So if unemployment is higher than expectations, if unemployment is higher, again,
They
that's
will pull
sort
back.
of negative happening,
Yeah.
then rates drop.
Yeah,
right?
yeah.
Then rates drop. So it's like an inverse effect. It's an inverse effect to how things are going in the world.
So this is kind of an unfair question to you because you always do well.
No.
Peter's like the busiest person
Well,
in the
thank
world,
you,
and he has a really, really good team that kind of supports
Have
him.
a
So
great team.
as much busy as he is, he's able to facilitate everything that we do. But is there a slowing down in the mortgage business? Do you feel like there's a challenge?
100%. No, listen, my peers, a lot of my peers are having challenging times. Yeah, I mean, they're having challenging times. as you know, right, there's been less buying happening.
Yeah,
right?
yeah, yeah.
Less inventory, less buying. Yeah, a lot of people are quitting the industry. A lot of people are quitting. I am happy to say, I just want a quick note for the brokers. The broker channel, the mortgage broker channel. I became a mortgage broker, as you know, in January of 2023. January 2023. It was the best move of my career. The best move of my career. And the broker channel is growing. There's more people. There's more loan officers. Well, I don't want to say leaving. I don't want to say leaving retail, but the broker channel is growing, which is really a good sign for us brokers.
Yeah.
We have more options. You know, we have more options, and I think we have better options and more products and better pricing than the retail channel for the most part.
100%. 100%. Again, Peter, as always, it is a pleasure. And every time that we speak, I feel like I learned something new. So this is why I love being around you. I'm like a little sponge and absorb it, as a company, we've been here close to 20 years, but I'm still a fledgling in the business, for lack of a better word. So I surround myself around people that's been in the business for a long time. Roger's been here 20 years. His brother's been here for a long time. You've been here for quite a while and everything like that. So it's always a pleasure and an opportunity to get to speak to you guys.
Thank you. Great hanging out with you.
Yes, sir. Yes, sir. We have the other video that we drop. This one is going to come out when it comes out, and then to learn the difference between a mortgage broker and a banker. We have a video on that one.
We did that.
Our first video, too. We have a video on that one. So go back and take a look at that one. We're going to drop some of those clips on Instagram and Facebook as well.
I'm going to keep this going, right?
Of course. I want to see if we can do at least once a week or even once a month, whatever works best for you, because there's always great information that's coming out.
Awesome.
It's Natasha Watkins, your favorite realtor, and Peter Karlin, the surgeon of mortgage. We out of here. Peace.
Thank you.